You know, some 401k plans now offer access to private investments. So should you add that into the mix?
Our money expert, Dustin Smith, he's from Wealth Enhancement Group. He's here with us this morning. Hey, Dustin, how are you?
Doing well.
First, can you explain to us these idea of private investments? Because I think a lot of us, our money goes into our 401k, you know, most likely an index fund of some sort, and then we kind of don't think about it again.
Yes.
Out of sight, out of mind.
So just like you were saying, so we all are pretty familiar with an index fund or a mutual fund. So think about that. They just take investors' money and then they purchase what we call publicly traded companies.
Right.
Companies we've all heard of, Apple, so on and so forth, right? So what we're talking about today is a private investment, like what we may call a private equity fund. And so what they may do, very simplistically, they will raise money from investors and they will take those dollars and buy typically a majority share in a privately held company, okay? And the big difference there is that they tend to hold these companies for multiple years with the hopes of providing them resources and expertise in order to grow over time, okay? But the biggest key there is they are privately held companies. And so historically, most people have not had access to buy this, right? So it's usually been held by what we call institutional investors, like pension funds, endowments, and or very wealthy individuals. But now, right, we are starting to have access in 401ks.
Some of us in our 401k, if we look, could say you have an option for include private investments.
Correct.
Why would this be a good thing for someone to invest in?
So let's talk about the pros. So some of the pros might be, you know, there's so many private companies out there. I mean, a private company can range from anything from a small locally
to a Cargill.
Exactly. So very, very, you know, so you can increase your diversification and, you know, participate in the growth of all these companies around the whole country. So that's a real, you know, pro. You know, some of them had, you know, very positive returns, but that's not guaranteed at all.
Right. I would think that this would be kind of risky.
Yeah.
Or riskier than putting it in a fund that was perhaps diversified of Fortune 500 companies.
Yes, you know, so you're still likely getting some of that diversification, but some of the concerns here, or maybe the cons, right, is that sometimes these funds have higher expenses, right? And also the lack of liquidity. Those are the two main concerns right now.
Because you can't get, you have to hold on to it for a little while.
So so historically, when you buy a share or when you own some of these funds, you generally, your money's locked up for a longer period of time.
How long are we talking?
So sometimes it could be multiple years, 5, 7 to 10 years.
So if you're nearing close to retirement, this is not a good idea.
Yeah. So what you know, so this is all really new. So what some of these companies are now figuring out is like, how do we make them liquid though? So it might not be as long as hold up as we've seen historically. Now, to be really fair, this is all really, really new. And I would say that the majority of people watching do not have access yet.
But might in the future.
But they might.
You think like maybe 2-3 years down the line this could change?
Yeah, I mean, anywhere from now to, you know, they might become more popular if they can kind of figure out some of those costs and liquidity issues. But you got to think about it, when you work for a company, right, those companies are concerned when they choose your 401k plan, right, they're choosing kind of the investments that are in there. And so there's some concerns that companies may not be as, you know, excited yet to offer these new holdings because of the potential risks and costs and so on and so forth.
Open it up.
So
interesting.
We'll see.
Okay.
A lot of things coming.
Yeah. All right, great. Dustin, thank you.
Yeah, thank you.